Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You may want to move your camera down. It looks like
Is that better?
perfect.
Yeah, just noticed.
Full Dimitri now. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to provide you with guidance, give you advice. There's the disclaimer.
Excellent.
Let me
What are you seeing today, my friend?
Yep. Let me take a look here. If you guys have any questions, you can put those questions on the live chat on YouTube. Type them in. Will's watching it. He'll read them back to me. If anybody wants to come on the show and ask their question live, we also provide a link to Zoom. Click on the link to Zoom. Once you get into Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody could hear you. You can ask your question then live and direct. While we're waiting for questions to come in, we'll start out with the pre-market report. You said there was a question outstanding yesterday. Well, I didn't get to.
Yeah, we have one question from Rob concerning the ability to search for bond muni ETFs, I think was the question. Rob's on. Correct me if I'm wrong, Rob, but I think that was the question.
Okay, so we'll take a look at how to find that. And if we don't have other questions coming in, what I think I'll do is go to some of the strategy benchmarks that we have out there, go over some trade setups, take a look at the benchmarks, what they mean, what they're telling us, and go, if we have time, go to the options chain and set up a strategy that could benefit from a certain type of output. All right. So
perfect. Let's
see if we can cover all that today. Let's start out with the pre-market report. And these are stocks trading in pre-market hours over here. And we have our most active list, a list of our biggest percentage gainers, biggest percentage decliners. Coming down here, 44 stocks made our percentage gainers list, 93 on the decliners list. From this perspective right now, we're looking like we're setting up for bearish bias at the open. I'm going to filter down this list to S&P 500 stocks only. We want to take out small cap stocks, ETFs, closed-end funds, preferred. So let's take all those out and focus on what's going on in the S&P 500 companies. And to do that, I'm going to use the filter up here in ETF, drop it down. We see a list of different ETFs. When you select one of these ETFs, the list below will get filtered by stocks that are holdings in that ETF. And the first one, you could see SPY, that's S&P 500 ETF. Clicked on that. Now you have a pre-market report that's filtered for only S&P 500 companies. And here we see 3 stocks made our percentage gainers list, 10 on the decliners. And again, from this perspective, we're looking like a weaker bias or a bearish bias at the open. Let's see if there are no questions here. I think I'll try to cover the what was the question? How to find muni bonds, muni ETFs, right? So, how do we find ETFs that are invested or have a focus in muni bonds? To do that, let's go under the screeners up here, and we have an ETF screener. So here, screeners, ETFs, and I should actually, build up this screener more because now we're getting a lot of more data coming in. But for today, let's see if we could screen out the municipal bond ETFs. Now, one way, we have all these ETFs in here, over 3,000. We have different tabs, and we have these filters above. Sometimes what gives it away though is in the name. So a lot of these ETFs will, in the name, will say something like muni bonds or these types of, and you can use this search. Let's try it, muni. So you could see here by just typing in muni, what it did, it was filter out 80 possibilities that have the word muni in it, right? But not all of them, right? Like here, this one's a communication services, so not all of them will have municipal, right? But this is kind of a quick way if you wanted to just do by keyword search, but I'm going to let go here. And we do have a bond type here. I'm going to drop it down, and it gives us different categories. So from our vendor, we, they do categorize them, and we use that category that they give us. And down here below money market, right here, municipal, right? So these are municipal bonds, and I'm going to click on that. And now we got 74 ETFs that are classified as municipal bond ETFs, which are tax-free bonds. You got to be careful with the tax-free also. Some of them have to deal with the state you live in. But here are a list of different ETFs, and they are sorted by highest volume. So this is yesterday's volume. But you can click on any of these columns to resort it. So the one that made the top of it was MUB, which is the iShares Municipal Muni Bond ETF. But you can see here, Vanguard has one, State Street has one, BlackRock has one. State Street has different ones. So you'd have to go in there and kind of read about it. Let me see if you click on this little info sheet, you click on the about, so you could read about him over here, and of course the makeup of them could be different. It could be different durations, different municipalities. Like this one looks like it's New York, right? So this one might be a New York bond, short maturity, and you do want to read about him. What is the focus of the ETF? From here, the fastest way is just click on that info sheet, click the about, and read it this way. And of course, if you want to go, there's a link here, and that will take you to the page, of this issuer. So if you click here, see, it's taking me now to JP Morgan Asset Management, and it's still loading. But once it loads the page, now you could read all about it here, portfolio, all this stuff that they provide. Okay, let me close this, go back to the ETF screener. I don't have much more to say about these muni bonds. If there are no follow-up questions on it, I'm going to leave it at that.
Yeah, that's fine. Rob is thankful that you showed him how to get there.
Okay, awesome. So let's move on to, let's look at the strategy benchmarks today. I'll use SPY, I think, as an example here. And under options here, we have a tab strategy benchmarks. And what this is doing is you could see these tabs. It's showing us different strategies, option strategies. And what it's doing is it's taking this strategy and it's creating a benchmark, kind of like the VIX, right? So VIX is a benchmark. There's no actual asset VIX, right? There's no, like, you can't buy the VIX and buy all the outstanding shares of the VIX and you own a company. It's not like that. The VIX is just kind of a calculation. It's a benchmark that you use that could then point to where you could go to the options and determine are the options higher or low. Okay. And this is a similar concept, except instead of tracking the VIX, which is like the implied volatility of a 30-day constant maturity option, this is looking at a benchmark of a certain strategy that you may want to do because you have a certain outlook, right? What call spreads, put spreads, out of the money call, out of the money put, ratio spreads, straddles, strangles, all these different types of strategies that you can utilize. The tools are there for you to analyze them, and based on your outlook, you might want to take a look at where the strategy is priced today relative to where it's been priced historically. Is it high or low? Okay. So let me take a look at a strategy here called I'm going to do the double bear. Okay. And the double bear is a strategy that you do two vertical spreads. You're buying out of the money put spread, right? So you're buying it out of the money put spread, and that will cost you money, right? It's a debit because you're buying one strike, selling the strike below, and you want the stock to go down, and ideally, go to your lower strike that you're short. And there's a debit that, and you have a bearish outlook. So the double bear, what it does is also sell at the same time and out of the money call spread, because that's also bearish outlook, but you're receiving a credit. So you're doing two things. You're buying a debit put spread, paying. You're selling an out of the money call spread, you're receiving. So then you net them out, and then you may receive a credit, or you still might pay a debit, but not as much as you would have if you just did the put spread. So that's the strategy. And I'll try to set it up to show you what it looks like on the options chain. And there's certain right now advantages to doing a bear call spread when interest rates are higher. Okay. When we're talking about trading efficiently and stuff, there's certain benefits of being bearish doing it with options. And it has to deal with that the options are pricing in the risk-free rate. Okay, they're pricing in that cost of carry. And when you short a stock, your broker may not be paying you that risk-free rate on the capital or the money you have that's sitting in your account. All right. But doing it with options, you will take advantage that the options are pricing in that the cost of carry and the cost of borrowing. Okay. So let's take a look at what this double bear looks like. The first one, you can see there are different benchmarks. The first one is looking at a 30-day maturity. Just like the VIX, the first one's looking at what if I benchmark it to an option that has 30 days to go. Of course, it's a calculation because there's never a 30-day option that's listed every day. We don't have that, a new one listed every day. So we have to create a benchmark by looking at the surrounding options and doing a calculation. And, I'm not going to get into that calculation, but similar to what the VIX is doing. And on the 30-day maturity, what we did further is we normalized the distances of the strikes, okay, away from the at the money spot price. Okay, so we normalized the distances by percentages, and that now makes it when we're using the percentages, makes it then a a benchmark that we could follow and then compare across assets. So imagine like this. If I said, what's a $5 put spread in Apple? Well, a $5 put spread in Apple is not the same thing as a $5 put spread in Bank of America, and it's not the same thing as a $5 put spread in, like, say, Amazon or Alibaba, because those stocks are different prices, right? So $5 put spread in $1,000 stock is not the same thing as a $5 put spread in a $20 stock, because the percentage move to cover that put spread is much greater in a $20 stock than it is in a $1,000 stock, right? A $1,000 stock could cover that $5 really quickly, and a $20 stock to cover $5, that's a big percentage move, right? 25% or whatever. So you could see that we can't just use strike prices. We have to convert it to the distances from that the money. So then we could normalize and compare, in Amazon versus Google versus all these. And so the first benchmark is looking at an out of the money call spread. So you're selling a 2% out of the money call and buying a call that's 5% out of the money, right? So if we benchmark it from at the money, 2% above that the money's, that's your first sale, and then you're buying a call 5% away. So basically you have a three, the distance to cover both of those strikes would be 3%. Okay, that's the max, 3%. Instead of dollar terms, we're doing it in percentage terms. Now, to the downside, we buy a put that's 2% away. Okay, so we look at the spot price, and then we look at a put that's 2% below that, buy that put, and then we sell a put that's 5% below. All right. So you could see that we're selling a call spread, and then we're buying a put spread. So how much would that cost us? Right? That's the idea. Well, what does it cost us? And we got to normalize that too. So we take the cost of it and we convert it as a percentage of the stock price. All right. So that's what we have to do. We say, well, if the stock was 100, right? Let's say we normalize it all to 100, right? So how much would this spread cost me to do? So I know if the stock's 100, in my best case scenario, it's 3% away, I could make $3, right? The distance is 3%. The best I could do is make $3. So how much would this cost me to put this on? Well, right now, you're getting a credit. So you're actually receiving money to take that short position. All right. And this is what it would look like. If it goes down, the stock goes down, then, between your long strike and your short strike in the put, it's going up and you're making. So in this case, it'll be 3% of the spot price. And if the stock rallies and goes up, then you're losing on your call spread, which is, you could see here. So this is what the payout diagram looks out on the option profit calculator. And here, between these strikes, right, that over here is where if the stock expires anywhere between these strikes, all these options become worthless, right? And at that point, your profit and loss depends on the cost of the initial transaction. So if you receive the credit, then you get to keep that credit. Everything's worthless. If you paid a debit, then you're out of that debit. All the options are worthless. Whatever you paid for it that you lose that. So that's why this area is it's gray, because we don't know. But here we see that's a 3% credit. And using these benchmarks as percentages, then we could easily just compare them, right? We could compare them across assets, we could compare them even with more days to maturity. So here we go out 120 days, it's a 6.6% credit, not 1%, 0.6, 0.6% credit. And let's see how that looks in SPY here. I'm going to go to the options chain. And let's see, where did I say we could go out to? Let's go out. Let's just go out further out. Let's go to March. All right, so this has 69 days already, trading days left. So when we find it, we could find the strikes that are further away. So let's just say we'll do this one, right? 2%. So we sell that one, the call, 401. Then let's say we buy the 5, 413. So that's the first one. That's the call spread, right? So the call spread would look like this. We receive a credit, 557. Now we want to buy a put spread. So ideally, you want the same distance of the strikes, but I'm just going to do it here. So the 385, then let's see, 373. So I'm buying a put spread now. Let's recalculate it. So you can see here, that's a credit of $1.88, right? So right off the bat, we're getting a credit. If we hit that bid, we want to try to get the midpoint. But here you see that between these strikes, right? So even if the stock doesn't move right now, it's a short bias. It is a short bias, as you see. If this goes down, right, we stand to make here 1388. Okay, so it is a short bias. But even if the stock, let's say, just sits here from now to then, and this is where it ends up, well, we received a credit, and all these options will be worthless, right? Because all of them are out of the money. All the ones that we sold and bought from this spot, they're all out of the money. So the calls are all out of the money. The puts are all out of the money. If we just stop here, then we receive this credit. If we go down, of course, then we're actually doing much better. And if we go up, that's where we lose. So over here, just based on this alone, right? This alone, what we're doing is risking, looks like $1,000, right? If things go against us and just rips, we're risking $1,000 to make 1388. So that ratio looks good, right? Because if you're looking at today's prices and you think, well, I think we have an equal chance of going up and going down because the risks are pretty high. If you think that the risks are even higher on the way down between now and March, then this is actually a really good setup. So it kind of depends on your outlook and forecast. But let's just say that we think that, that the risk to the downside today are greater than to the upside. Well, then these odds look pretty good because the payoff to the downside is greater than the cost to the upside. Not only that, you got this area right here, right? Just in case, maybe it's not going anywhere. It's going to stay right here, right? Maybe it'll stay right between these strikes, up to whatever it is, 400, 401, and 385. You're still getting that credit. And some of that has to do with that the calls are now reflecting higher interest rates. So the calls are more valuable when interest rates are higher, and puts are the opposite. They come in. So when we're buying puts here, selling calls, we're also theoretically receiving some of that cost of carry while we wait, right? Because as we wait, that interest, that cost of carry is priced in, and every day should leak out. So that's one, looking at a benchmark, right? So what do? We started with a benchmark. We saw that the benchmark right now versus historicals looks pretty good, because if we're taking this outlook, we do define our risk. So we do have limited risk to the upside in case this thing rips and we're completely wrong, because that, of course, can happen in any, strategy from now till expiration. We don't know what's going to happen. So if we're really long, we locked ourselves out, we limited our risk. The ratio, if we are right and there's more downside risk and pressure over time, then this looks good, because just from comparing those two versus each other, risking $1,000 to make 1,300 if we think it's just 50-50 either way. And then we got this little area here that we win on if just nothing happens, right? And the strategy benchmark, let's just come back to it. I'm going to come back to the double bear. And what it's telling us here on the 30 days, we're getting 0.3% credit, which is a little bit above the 52-week average. So from yesterday's close, it was actually bid up a little bit. And if nothing happens and it reverts, right? If we just sit here and it reverts there, then we got a little bit of extra edge there, right? On the 60-day, it's 0.5%. So our benchmark's telling us that, you get about 0.5% credit for putting the strategy on versus 52-week average of 0.4%. So that looks also like, hey, if we just sit here and it reverts back to here, then we got a little bit of extra credit, okay? Then where the options usually price it, right? Because there's a lot of skew in those options. We're doing a lot of different options with a lot of different strikes and distances away. So here, a little bit of that edge is coming from the way the skew is lining up, which is the difference in implied volatilities, the difference in the premiums between different option strikes. All right. Hopefully this was helpful. I don't know if you got any questions. Oh, tomorrow, by the way, let's remind everyone, tomorrow, Will and I are out. No show tomorrow. We're going to industry conference. Oh, Will, you're on mute.
Yeah, I had a little bit of a sneezing fit. I apologize about that. No questions, and can't wait for the Benzinga conference tomorrow. Should be fun.
Yep. All right. Well, thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys Friday.
All right, great.